Guys, Alibaba just reported, and they reported big. They were expected to do $2.01 in EPS. They reported $2.40. Revenue expectations were $30.98 billion. They reported 32.3. They're up over 6% about 1 hour into trading. They were up over 7% at one point. Guys, just to bring it up right now, Biden yesterday signed something involving a ban on investing in Chinese companies involving AI. Will this affect Alibaba? I'm sure it's going to affect them in some way. I don't know exactly what it is. We just want to address it and say, hey, we are aware, but I don't know enough about this thing one day later. It's probably political posturing. I don't think it's probably much validity, just like when Trump had his bans on things back in his term. So in this video, we're going to go over the earnings of Alibaba, what we think of Alibaba. In full disclosure, Mo and I both have very mature positions in Alibaba. That does not mean you should buy Alibaba. We are here to teach a process. We're not here to tell you, go buy this company. You should not be looking for that on YouTube. You should learn a process. If our process speaks to you, subscribe to us, learn from us. If it doesn't speak to you, find some other method that works for you, because that's what will enable you to do better in the long run. What works for Warren Buffett doesn't always work for me, and all these other things. There's so many people out there with a different process. You're going to do the best with your own process. So let's take a look at some of the higher metrics on Alibaba. It is a $260 billion market cap company. That means if you bought every stock at the market price, you'd pay $260 billion to own every single one of them. Mo, did you see their enterprise value?
276.
$275 billion, whatever. The difference here is essentially their debt. Guys, that's $15 billion in debt. And let me show you something. Look at their free cash flow. $28 billion in the last year. So they can essentially pay off their difference between market cap and enterprise value, their net debt, with 1 more year of actually 7 more months of free cash flow, 8 more months of free cash flow. That's incredible. That's a great balance sheet. That is, what was that, Mo?
That's a lot of free cash flow.
So that's the thing, Mo. Look at this. Their earnings last year were $10 billion. Their free cash flow were $28 billion.
Wow.
So guys, earnings don't match up with free cash flow, and we love it when it's free cash flow higher than earnings. So earnings have been subdued lately, but look at the price of free cash flow, Mo, 9.38 and a 5-year average of 13.8. Here, their PE is 25.75 with a 5-year average of 18. So their free cash flow is better than their earnings. And this can happen a lot with companies that are, what they do is they capitalize a lot of their expenses and in years past, and now they're being deducted every year. So for example, if we create software that costs $1 million, the government doesn't just let you immediately deduct that $1 million. There's a certain time frame. It's even better in a car. If they buy a vehicle for $100,000 and the government lets them deduct it over 5 years, the cash flow will be lower by $100,000 the first year. But then every year they deduct $20,000. So it makes the earnings lower over the next few years. That might sound complicated. And on this channel, we have information for more beginner investors as well as more advanced investors. So this is probably more for the advanced. But if you are a beginner, it'll make more sense as time goes on. Just be patient. Now, guys, one area of a little bit of concern, well, look at their 5-year return on invested capital. It's pretty low.
Yeah, it's pretty low.
Now, with company, I don't know the reason for that. There could be a very good explanation for this, but this is a very low return on invested capital. I don't like that. Return on invested capital means they're not getting a great return on the money that's invested in the business. So the reason this stinks is, well, equity investors are going to require a much higher rate of return, and debt investors, when they lend money, are going to require a high rate of return higher than this. So if they're only getting a 5.5%, but they owe, let's say 8 or 9% to debt and equity combined, they're actually destroying wealth. Now, this can be skewed for companies that are still growing and reinvesting back in themselves, which could be the case here, but who knows? Okay, so that's one of the biggest issues I have with Alibaba is that. So Mo, is there an annual report? Is there a quarterly report, annual report here, the quarterly report here that we can look at from Alibaba?
Yeah, and they have a lot of good comparisons too. So they did 14% growth year over year in overall revenue.
Yep.
And as we come down further, and you remember they were going to split into 6 different areas. So,
oh yes, 6 spinoffs,
yep,
right?
6 different spinoffs. So we come down here. Let me go to the more specific.
So just to let everybody know what that means is they announced in the last quarter or so, that they were spinning off the six major divisions of the company. Because a lot of times companies will say, hey, our parts are worth more than our whole. So if we have a $260 billion market cap business, but if every single part, all six parts separate, might be worth $400 billion. So they might do that to generate more increased value for the investor. So go ahead, Mo.
So if you come down here and you look at their KNOW, Smart Logistics, it grew 34% year over year.
Wow.
For quarter over quarter. Cloud Intelligence here had 4% growth.
I'm kind of surprised it's only 4% growth.
I am too.
Mo.
That one's very surprising. There's some numbers that are very large. Like there's one number in here, I can't remember where it was. It was like 34% growth. So this is the digital media, only 5%. That one's small.
Their share repurchases. Let's jump to that.
Big. Okay, so their share repurchases, they have a $3.1 billion program underway. They repurchased 284.4 million shares, because this is in their ADS, but they still have a lot of shares that they could repurchase under that current program.
And I love that.
You like that because the price
of this.
Exactly.
The price of free cash flow. Guys, buying back shares is awesome when the stock is selling cheap. They're sitting there. And by the way, that's a great thing also when they have a low return on invested capital. So if this return on invested capital stays low, their job should be to return money to investors through dividends and share repurchases. And as long as the price of free cash flow and PE are low, do nothing but buy back shares. Do not pay a dividend. Just give me more and more ownership of the business just by being a patient investor. That's how you can drive up earnings per share. Because if they buy back more shares, now the revenue, profit, and free cash flow are being divided up by less and less shares, but you still own the number of shares you had before, so you get a bigger and bigger piece of the pie as they buy back more shares.
And here's some financial comparisons. You could see income from operations grew at 70%.
Oh, wow.
Revenue, 14%, like we said. Net income, 63%.
So my guess is that 70% income from operations is going to drive up return on invested capital, because return on invested capital is determined with net operating profit. So that's going to really drive up that return on invested capital.
Here's this Taobao. It's commercial e-commerce over there. 10% increase in customer management. Direct sales increased 21%.
Look at that 60% increase in international commerce retail.
That was a big number. Here was this logistics. This is the 34% number I was talking about. A 34% increase. So they are doing.
Wait a second. Hang on a second.
International commerce retail increased 60%. Like you just
thought
said.
Their digital media was like much lower than 36%. Didn't they announce that before as lower?
Let me go back up here.
I thought it was much lower than that.
It was like 4%.
Yeah, I thought it was 4% before up top. Did we find an error, or am I thinking of it wrong? I'm definitely probably thinking of it wrong. Right there.
Digital commerce. Let's see.
Oh, no.
So
the digital media. Go up further. Go up further.
Oh, this here?
No. Where does it say digital media?
So we were talking about Taobao. So.
Okay. Well, either way, that's a big jump. 30-some%. Guys.
Big jump.
China is a growing market. Are there risks? Absolutely. But remember, when we first started talking about Alibaba, the big scare was, you don't own the shit, you don't own the company, you own. And I was like, okay, fine. So they get delisted from U.S. exchanges. I get my shares in Hong Kong, and I own the shares in Hong Kong. That's what he found from Schwab. That's what I found from Merrill Lynch when I talked to them.
So I was thinking about this morning, and I don't know if they're the biggest company in China anymore, but they were once the biggest company. They were once probably the best company in China. The bet here is if Alibaba doesn't work, that means China doesn't work.
So
right? That's a very, very simplistic way of thinking about it.
But I like simplistic.
But that is, I'm looking at this going, if Alibaba fails, that means that China fails. And
well, I don't know about China fails, but
for lack of
there's such
struggle,
at $125 or $130 billion, it would take a lot for them, especially in the environment they're in. So here's to Mo's point. China's got the fastest growing middle class in the world. You're talking about a country that is growing like crazy. What do middle class people like to do? Buy stuff. So when they're buying stuff, they're going to go to the world. They're going to the country's largest retail provider. It's like us in the U.S. When we buy more stuff, we're buying more Amazon stuff. So I look at this saying, so I've talked about this before, and if you're new to the channel, I want you to hear this. My questions when I look at a company are this: the three major questions. The first off, do I think this company will be around for the foreseeable future? And I think Mo and I agree that the answer is yes. Barring some major unforeseen incident, yes, it'll happen.
Yeah.
2, Do I think their revenue and profit will increase over the foreseeable future?
Yes, I do.
And I agree with that. I think so too. And the final question, can I pay a reasonable price for the company today that gives me an adequate return based on the future I see? And when I see 9 times free cash flow, I say, yep, I'm paying a reasonable price for it. Mm-hmm. And the company's taking their cash flow and buying back shares. So it's giving me a bigger and bigger piece of the company as time goes on. That's my bet on Alibaba. Now, am I right? I don't know. Michael Burry's made a bet on Alibaba and JD. Charlie Munger has said he was the thing he was most wrong on in this world was Alibaba, because he thought it was more of a technology company than it actually was. But Charlie Munger started buying at $250, I believe.
Right.
So it all depends on what price you're buying at. And my basis on Alibaba is much lower than it is today. Like, I think I'm up now with this, probably 15. And guess what, guys? That doesn't mean I'm right. That does not mean I'm right. All it's saying is that my basis is very low, where I'm cool. I'm fine saying, listen, go back to $58. They're low. I'll just probably buy more shares.
And what I actually like to see here in their shares outstanding is, while this was a crazy hype company and everybody was buying them, they were diluting you. Sure, that sounds, I mean, I don't necessarily like it, but as a growth company like that, I'd rather them do that than take on debt. And then what did they do when their price got low enough? They reversed it and they started buying back their shares.
Smart capital allocation.
Exactly.
Guys, as Alibaba grows with the Chinese economy, that's it to ask yourself. Look at China's economy over the last 30 years. Let's look this up, Mo. Look at China GDP by year. Let's just look this up. These are the growth rates. I'm not going to look at I want to see the overall China GDP. Okay. GDP. This is in trillions of dollars for China. In what year is this? Not telling me a year. 1998. So when I graduated high school in 1999, they did about $1 trillion in GDP. Mm-hmm. They now do 18 trillion, 18x growth. The US didn't have that, and that's okay, because China has much poorer environment and they're going to grow. Look at their per capita. Their per capita is 13,000 per person. We're at 60-some thousand, 70,000 per person.
We had that at one point.
Of course we did, when we were a much smaller country.
Exactly.
It's okay. China, India, and eventually Africa will be the faster growing environments for. Pretty soon, China will get to the point where we're like, oh my God, China's so slow.
Let's go somewhere else.
Yeah, let's go somewhere else. Mm-hmm. Because look at India. I mean, this is what I want to get to is, let's look at India's GDP per year. Look at the same thing here. So China was at 18 trillion. India is at 3.4 trillion. China has 12,700 per person. India's $2,300 per person. So they're gonna be the next China. They have more population than China. So there's gonna be a much faster growing middle class. And my bet on China, my bet on Alibaba is a bet on China. And for everybody out there who hates China, grow up. Grow up. It's okay for us to grow along with China and China to grow faster than us. And China will be bigger than us at some point in the future, just like India will. That's okay. Because look at Great Britain. We're way bigger as an economy than Great Britain. Has Great Britain sucked in the last 100 years since we overtook them? No! They've still done great things. Let's not think about this as us versus China. Let's look at it as the world getting better. And eventually, at some point in the future, it'll be Africa as the next frontier, and India will be the slow grower, and China will be ancient, and the US will be considered dead. And none of those things will actually be true. Mm-hmm. We can still all grow effectively. And that's what I want everybody to remember. So back to Alibaba. Let's see what the analyst estimates are. Alibaba is exactly $100 on the nose right now. So not a lot of growth in EPS. They're expected to do $7.58 this past year, growing to 13 and change in the next 4 or 5 years. So low double-digit growth. Let's look at revenue from our analysts. High single digits. Yeah. 123 in revenue to 195. Yeah. So in the next year, they're expected to do 134, which is about 9% growth, 9.03. Okay. Guys, guess what? You can buy slow-growing companies and make a ton of money because everybody's overlooking them. Everybody's overlooking them, right? Mm-hmm. All right. So Mo.
We're scared of them.
Yeah. Guys, let's go to the Stock Analyzer tool. Now, this tool is the most popular part of our site. It's been used well over 2 million times since we introduced it. And the reason it's so effective is when you're when you're learning about investing, you have to remember that when you buy a stock, you're buying a piece of a business and you're buying a future stream of cash flow. And based on what you pay for that cash flow, that's what your return is going to be. And that's what this does here. It allows you to make assumptions about the future and then tells you based on those assumptions, what price to pay today. It pulls all the data for you. You don't have to go to Excel. You have to just pulls all the data for you. So if you like the software and all of our tools involved right here, all these tools, including the real estate calculator, which will be grandfathered in because it's going to be its own separate software soon. And if you like the idea of chatting with thousands of investors, guys, this decreases the stress and anxiety in investing. This software here is what Mo and I use every day. It decreases our stress about investing because it allows us to say, what price am I going to pay? Is it lower today? I'm going to buy some more. All right. So let's go do a little analysis. So go to everythingmoney.com. For about $1 a day, you can have all of this software locked in. Go sign up now because every month the price goes up. What are you smiling about, Mo?
I did the stock analyzer in my head, and then I went to my history and pulled up the numbers, and they were exactly the same numbers as back in May.
Great. So give me your revenue.
Changed.
So give me your revenue. By the way, look at our ROIC over the last 10 years.
Exactly. I was looking at that when you were talking about it earlier in the video.
So they had the high ROIC when they were growing.
I just think there's something skewing that.
It probably is.
Yeah.
All right, so Mo, give me revenue, low, middle, and high for the next 10 years on Alibaba.
So I have 5, 8, and 11.
Okay, I like it. Profit margin.
15, 19, and 23.
Okay, so what Mo's doing here is he's looking at these things and going, okay, they'll probably do 19 because they did 19 over the last 10 years. Mm-hmm. 15, I think these are great numbers because as they grow their higher margin businesses like cloud computing, everything, they could hit 23. But is this a big number? It is.
Yeah.
But that's okay because we want a big number for our high number. Right. We want a low number for our low number. And the middle number is what we want, what we probably think it's going to do.
Right.
All right, what about free cash flow?
So I did 17, 22, and 27 here because they always have more free cash flow margin.
Oh, look at this. It actually makes me feel like the profit margin is probably too low. Isn't that interesting? Because free cash flow and profit margin should eventually equate to each other. Yeah. Wow. Okay. Now, PE. Here's the issue with PE, guys. Everybody goes to PE and looks at the history and goes, oh, it's 20. What you need to do is start at 15. And you go up based on growth rate, moat, ROIC, and you go down based on the exact opposite. So if it has a high growth rate potential or a high ROIC or a very big moat, you want to go higher. Keep in mind that in 1988 or 87, when Warren Buffett started buying Coca-Cola, he paid about 30 PE, and he's still done well. So why? Because Coca-Cola has such a big moat. Does Alibaba have that moat? I do not think so. Does Alibaba have a good hold in China? Yes. Would you consider it a moat? I don't know.
Yeah.
So Mo, give me your PE and price of free cash flow multiples for Alibaba.
So I said 16, 18, and 20.
I actually think lower.
Really?
I think 14, 17, and 20.
Okay.
And the reason being is...
Yeah, what's the reasoning?
I can even justify going a lower PE. I mean, it's still China. There's still a lot of unknowns. There's still a communist country there. But I can always factor that in my desired return, which I probably will do. But I don't think the moat is as established there yet. I think as time goes on, that moat will be bigger and bigger, which is why 17 is fine for me on the middle.
I actually don't know if the moat will be bigger and bigger because what if Amazon starts to expand into China?
Yeah, that's true. But you know what? But look at it this way. China wants to promote China.
Yeah, that's
just
true.
like US wants to promote US.
That's true.
That means people think the way I do, which is this is all good for everybody. So now, desired annual return. Guys, this is where you factor in your risks. The more risk, the higher return. The more assumptions, the higher return. This is your margin of safety. Usually in a big company like this that's based in the US, we probably start at 9, 10, or 11%. But I think here with China, we got to go a little bit higher. So Mo, what did you do for desired return?
So I did 12, 14, and 16.
I like it.
I could see anybody wanting to go higher though.
100%. Now guys, so keep in mind here, stay with me for just a minute or two longer. We're going to finish the video, but I want to explain these numbers so you truly understand our process. This is not just about handing you numbers and saying, go do. It's about learning that process so that when you're up at 3 o'clock in the morning researching stocks, you can come on our software and figure things out for yourself. But the key here is to do your own research. I love these desired returns because I think to myself, I think if I can make 14% on Alibaba for the next 10 years, I'd be very pleased. And I think it accommodates all of my assumptions here. So I hit the analyze button, Boom. Wow. Basically a low of 95 to 110, a high of 213 to 250, a middle price of 150 to 170. But here's the last line here that's super important. If you pay today's price and the lowest assumptions occur, you're going to make 13.4% on a free cash flow model. If the middle assumptions occur, you're going to make 22.5%. If the high assumptions occur, 31%. Again, don't buy just because of this. Make sure you understand the risks of investing in China. It's very volatile and people want to take a crap on it all the time. So guys, if you like this, like the software, everythingmoney.com, go sign up for about $1 a day. Take care.